I have watched markets for a long time. I have seen booms that felt like they would never end. I have seen crashes that felt like the world was breaking. And after all those years, there are only a few moments when I feel the need to say, stop, slow down, pay attention. Not because I am excited, not because I want to sound dramatic, but because the risk of sleepwalking is high right now. So take a second, put the noise down, close the extra tabs in your mind, and listen to this like it matters, because it does. Most people think they are doing the safe thing with money. They buy broad index funds. They keep adding each month. They repeat the line, time in the market beats timing the market. And yes, there is truth in that. Patience is powerful. But there is also a lazy version of that advice. A version that makes you feel safe while your money is quietly tied to businesses you would never choose if you actually looked inside. The main number you see on your screen is not the full story. It is the cover of the book. What matters is what is happening behind that cover. And if you only stare at the cover, you will miss the part where the ending changes. Let me explain it in a simple way. Imagine you buy a big bag of trail mix. The label says, average quality, pretty good. You bring it home. You open it. Some pieces are fresh and perfect. Some pieces taste old and stale. But you paid one price for the whole bag. That is how a broad index can work in a market like this. Inside one index, you can have companies that have soared in price in a short time. Real companies, real products, big demand, big growth. Right next to them, in the same index, you can also have companies that are down a lot. Not down a little, down so much that the future looks very different than the past. Some have famous names. Some have been around for decades. Some are on shelves in your home, but their business is under pressure. The index blends all of it into one smooth number, one easy chart. And many people never notice they are paying for both the strong and the weak at the same time. Now, I am not here to say index funds are bad. They can be a great tool for many people. The point is something deeper. In a moment when winners and losers are splitting apart, the average can hide problems, and the average can also hide opportunity. Here is the uncomfortable truth. Diversification protects you when you do not know what you are doing. It spreads your risk. That is good. But if you want to be more than average, you have to be more aware than average. You have to know what you own and why you own it. That is not the same thing as being reckless. It is the opposite. It is being responsible. So what is really happening right now? Why does this moment feel different? Let's break it down in plain words. The first thing you must understand is inflation, not the fancy version, the real version. Inflation means your money buys less. The same paycheck feels smaller. Food costs more. Gas costs more. Rent costs more. The basic bills get heavier. When this happens for a long time, the economy starts sorting companies into two groups. Group 1 is made of businesses that own or produce real things the world still needs. Physical materials, energy, key resources, things that do not disappear because an app is popular. In an inflation world, what they sell often becomes more valuable because the cost of real stuff rises. Group 2 is made of businesses that depend on people having extra money after paying the basics. These businesses sell the nice-to-have things, the extra things, the upgrades, the easy spending. When inflation squeezes families, that extra spending is the first thing to drop. People do not stop buying everything. They stop buying the optional stuff first. And when millions of people do that, the companies selling optional stuff feel it in sales, then profits, then stock price. This is not a theory. This is not a guess. This is a pattern that shows up again and again when money gets tight. The second thing you need to understand is what I call the no fuel problem. A lot of big money managers are already loaded up. They have put almost all their cash into the market. Think about what that means. If most of the big buyers have already bought, then the whole market cannot rise fast forever just because everyone feels hopeful. So where does new buying power come from? Often, it comes from switching, from rotation. When big investors want better results and they are already fully invested, they usually do one thing. They sell what is weak. They move money into what is strong. They cut the parts that are not working. They add to the parts that are working. This rotation can be quiet at first, then it speeds up. And if you are holding a mix of winners and losers without knowing it, you may feel stuck. You may watch your account move sideways while money runs past you into a smaller group of strongs. Our areas. Again, this is not about predicting a crash. It is about noticing flow. Money is always flowing somewhere. The question is whether you understand the direction. The third thing is more personal, and it matters a lot. Real wages are under pressure. That means even if some people get small raises, prices can rise faster than those raises. The result is simple. Many families feel poorer, even when they are working just as hard. And that changes the whole game for businesses that depend on the average shopper. When buying power falls, you get slower spending. Then you get lower growth. Then you get layoffs in some places. Then even more spending slows. It can become a loop. Markets often price this in before most people feel it fully, because markets look forward. But many investors do not look forward. They look at yesterday's chart and assume tomorrow will be the same. So here is where we are. We are in a market where the gap between strong and weak is getting wider. Inflation is changing who has the advantage. Big money is rotating because it does not have much fresh cash left to push everything up together. And the average family is being squeezed, which hits many consumer businesses first. Now comes the real question. If the market is not one smooth road, but a road with sharp turns, what does a smart investor do? Do you keep buying the whole trail mix bag without checking what is inside? Or do you start learning how to spot business strength, business weakness, and the difference between a story and a real engine? In the next part, we will talk about where the opportunity can show up in times like this, and why it often looks boring at first. We will also talk about how to avoid the gambling mood that takes over when people chase fast wins. Because the biggest mistakes do not happen when people are calm. They happen when people feel rushed. And a simple rule can protect you. When you feel rushed, pause. When you feel pushed, step back. Because the market will always offer you excitement. But wealth is usually built by steady thinking, not fast clicks. Now let's talk about where opportunity can appear when the market splits into winners and losers. Because when people hear the word opportunity, they often think it means one magic stock, one secret tip, one fast move. That is not the real kind of opportunity. The real kind is when the world changes and most people keep acting like nothing changed. Right now, one big change is this. Real physical things are getting more valuable again. Not every day, not in a straight line, but the trend is clear. Some people call this a super cycle. That sounds like a big Wall Street word, but the idea is simple. It means the world starts needing more of certain basic materials, while it is hard to make more of them quickly. When demand rises faster than supply, prices can rise over time. That can lift the businesses connected to those materials. Why would that happen now? Look around. Countries are spending on infrastructure. Power grids need upgrades. Data centers are growing. Defense spending is higher in many places. Supply chains are being rebuilt. And many mines and energy projects take years to start. You cannot snap your fingers and create new supply overnight. So you get a squeeze. Not always visible at first, but real. Now, when most people hear real assets, they think about one thing right away: gold. Gold is a strange asset because it does not make products. It does not pay a dividend. It does not grow like a business. It just sits there. So why do big institutions still care about it? Because gold is often used as a trust signal. When people feel unsure about paper money over long periods, they look for something that cannot be printed. And when central banks buy gold, that is not because of hype. It is usually because they want a backup plan, a hedge, a second option. That does not mean gold must go up. Nothing must happen. It simply means something important. Some of the most powerful money players in the world are acting like trust matters more now. And when trust becomes the story, gold usually enters the conversation. Now let's move to an area most people ignore until it's already on every headline: uranium. This topic sounds far away from everyday life, but it is tied to something very modern: electricity demand, data centers, artificial intelligence, and the need for energy that works all day, not just when the wind blows or the sun shines. Many countries are looking again at nuclear power, not as a political slogan, as a math problem. They need a lot of power, and they need it steady. Uranium supply is not simple either. Production is limited, new projects are slow, and some countries do not want to rely on others for critical materials. That mix can create tight supply conditions. And tight supply is one way prices can move. But here is the rule. Resource markets can be wild. They can jump. They can drop. They can do nothing for a long time and then move fast. So if you ever study areas like uranium, you do it with a clear head. not with excitement. You ask simple questions like an owner. Can this business survive low prices? Does it have too much debt? Is its cost to produce low enough? Is it in a safe location or in a place where rules can change fast? Now let's talk about copper. Copper is not flashy. It does not trend on social media, but it is used in almost everything that moves power. Electric cars use more copper than gas cars. Solar projects use it. Data centers use it. Power grids use it. So copper becomes a picks and shovels material for the modern world. And the problem with copper is the same problem with many key materials. New supply takes time, mines are hard to build, permits are slow, costs are high, and demand does not wait. So copper is another place where long-term pressure can build. Again, that is not a promise. It is a setup, a set of conditions. Now zoom out. Energy, in general, has been one of the quiet winners in inflation times. When prices rise, businesses that sell energy often collect cash. And when those businesses act wisely, they may reduce debt, buy back shares, or invest in strong projects. But the key word is wisely. Not every company behaves well when money is flowing. So if you study energy companies, you use a simple checklist. Do they spend cash like adults or like teenagers with a new credit card? Do they keep debt under control? Do they invest for long life or chase short-term growth? Do they have strong assets or just a good story? Now there is one more group most people ignore because it feels boring. The builders, the companies that make the world work, the firms that build power lines, the groups that maintain pipelines, the contractors that repair roads, the businesses that supply parts for big projects, the companies that work on defense and security systems, the firms that build the bones of the economy. These businesses rarely go viral, but many have long contracts, long demand, and steady work. And in markets like this, boring can be an advantage. Because when everyone is staring at the same popular tech names, the boring areas can stay under-owned for longer. That is where mispricing can hide. Now, I need to be very clear. Talking about these areas is not telling you to buy them. It is showing you how to think. This is about learning to spot where capital might flow when inflation stays high and the world needs real materials and real building work. Now, we also have to talk about risk, because every opportunity has a shadow. The same forces helping real assets can hurt other businesses. Inflation squeezes the shopper, and when the shopper is squeezed, businesses that sell optional things can slow down. You may see it first in small ways. Fewer people buy extra items. Fewer people upgrade. Fewer people sign up for subscriptions they do not truly need. That hits sales, then profits, then stock prices. There is another pressure too. Technology. Some service businesses charge high fees for work that software can now do faster and cheaper. That does not mean every service business is doomed, but it does mean some business models are being challenged in a deep way. And this leads to one of the most important ideas in investing: the difference between a cycle problem and a structure problem. A cycle problem is temporary: a slow year, a weak economy, a normal downturn. A structure problem is different. It means the world is changing and the business may not be needed the same way again. Here is a simple test. If the economy improved next year, would this business bounce back? Or is the problem that customers are leaving forever because a new tool replaced it? If the problem is structural, the old "it will come back" story can be dangerous. And here is where broad index funds can feel safe but still hold hidden risk. Because an index does not ask whether a business is structurally declining. It just holds it, and it holds it next to growing businesses too, all mixed together. So ask yourself this: if you were choosing on purpose, would you buy equal amounts of a business in a long-term growth trend and a business in a long-term decline? Most people would not. But many people do it without noticing, because it is bundled inside one simple fund. So what do you do with this information? You do not panic. You do not throw out every simple strategy. You do one mature thing. You start paying attention to what you own. You start asking, what is this business selling? And will the world need it more in 5 years or less? You start watching where money is rotating. Not daily, not hourly, over time. And you build a rule for yourself. When you feel tempted to chase what is hot, you pause and ask, is this a real shift in the world or just a loud story? Because stories spread fast, but rare. L change shows up in supply, demand, and cash. In the next part, We will tie this together into a simple way to stay on the right side of big moves without becoming a gambler. We will talk about how to spot capital flow, how to avoid weak industries, and how to build a calm plan that does not depend on perfect timing. The biggest mistake people make in moments like this is simple. They treat the market like a movie. They wait for a headline that tells them what to think. By the time the headline is loud, the move is often already halfway done. Smart money usually does the opposite. It watches the quiet signals. It acts before the crowd feels certain. And right now, one quiet signal matters more than most people understand. Money is rotating, not all at once. Not in a clean straight line. But the direction is real. You can measure it over time. You can see which areas attract more capital and which areas keep getting sold. This is why the average approach can feel safe but still disappoint you in a market like this. When winners and losers are far apart, the average number hides both. It hides the strength and it hides the weakness. It is like driving a car using only the average speed for the whole trip. That number does not tell you about the sharp turns. It does not tell you about the traffic jams. It does not tell you about the steep hills. It just gives you one smooth number that can make you lazy. So what should you do instead? Not panic, not gamble, not jump into the hottest thing you saw online. You do something boring and powerful. You build a process. And the first step is to stop saying, I own the market, and start saying, I own businesses. Because when you own businesses, you naturally ask better questions. You stop thinking in tickers and start thinking in real life. Here is the first question. What is this business selling, and is the world moving toward it or away from it? That question alone removes a lot of danger, because some businesses are not just having a bad year. Some are facing a world that is changing. A new tool appears, a new habit forms, a new rule hits, a new cost shows up, and the old business model gets weaker, even if the brand name is famous. That is the difference between a temporary storm and a broken boat. A temporary storm passes, a broken boat sinks. So you need a simple way to tell which one you are dealing with. When a company is struggling, ask, is demand still there? Ask, is the product still needed? Ask, are customers leaving because they want something better, or because money is tight right now? Ask, if prices and jobs improved, would this company recover, or is the problem deeper? This is not about being perfect. This is about avoiding the obvious traps. Now, there is another problem in 2026 that makes people act strange. Many investors are in a gambling mood. They want fast wins. They want to feel smart today. They want the rush. The market always offers the rush. That is why it is dangerous. So here is a rule that can save you money. If you feel a strong urge to act right now, pause. Urgency is not proof. Urgency is often pressure. Here is another rule. If your reason to buy is everyone is talking about it, that is not a reason. That is crowd heat. Crowd heat can push prices up for a while, but crowd heat also disappears fast. And when it disappears, it leaves late buyers holding the bag. So if you want to stay out of trouble, you need to think like a calm owner, not an excited spectator. Here is a simple owner test you can use. Ask, if the market closed for 1 year, would I still want to own this business? If the answer is yes, good. If the answer is no, then you were not investing. You were renting a price move. Now let's talk about the other side of this, because it matters. When money rotates, it does not ask for your opinion. It just moves. It moves away from weak areas and into strong areas. And while it is moving, it can create big gaps. Some prices can look too high because everyone rushed in. Some prices can look too low because everyone rushed out. Those gaps are where long-term investors pay attention. Not because they want drama, because they want value. Value is not a story. Value is when the price is low compared to the business strength. So here is a clean way to stay grounded. You do not chase what is already expensive. You do not buy something just because it ran up. You watch. You study. You wait for a better price. You demand a margin of safety. Margin of safety is just a buffer. It means you leave room for bad news. You leave room for mistakes. You leave room for the world to be messy. People lose money when they pay a price that needs everything to go perfect. Now, you might be thinking, okay, but how do I know where money is moving without living on news? Good, you should not live on news. You only need a few simple habits. One habit is to watch which sectors keep me. King new highs over months, not days. Another habit is to notice which sectors keep failing to bounce, even when the market is green. Another habit is to read a company's results with one question in mind: is real cash getting stronger or weaker? Another habit is to listen for how leaders talk. Calm, clear, and honest is different from loud and dreamy. None of this needs fancy math. It just needs attention. And attention is rare now because everyone is distracted. That is why the people who win in big moments usually do not win because they are geniuses. They win because they are awake. They notice what others ignore. They see the slow shift early. They do not need to predict the exact date. They just need to avoid being last. Now I want to say something that sounds harsh, but it is true. Many people do not need more information. They need fewer excuses. They already know the basics. They know debt is risk. They know overpaying is risky. They know hype is dangerous. They know panic selling is painful. But when the crowd is loud, they forget. So you need a personal rule book. Short, simple, clear. Rule 1. I do not buy because I feel left out. Rule 2. I do not sell because I feel scared. Rule 3. I only own what I can explain in plain words. Rule 4. I do not risk my future to win a month. Rule 5. I do not confuse a rising price with a strong business. If you live by rules like that, you will already be ahead of most people. Now here is the final point. The window for easy positioning does not stay open forever. Not because someone is closing it, because once the crowd agrees, prices change. Once everyone sees it, it is no longer cheap. Once the story becomes popular, the advantage fades. This is why people look back later and say, I wish I acted sooner. Not because the facts were hidden, because they were not paying attention when the facts were still quiet. So here is the question that matters. Are you going to keep holding everything the same way just because it feels simple? Or are you going to take one weekend, slow down, and learn what you actually own? The money is moving. It is moving while people argue online. It is moving while people chase the next viral idea. It is moving while people say, I'll deal with it later. And later is always more expensive. Take this as a wake-up call, not a fear message. A wake-up call to think clearly, to be an owner, to demand margin of safety, to avoid the gambling mood, to focus on business strength, not market noise. Because you do not need to be first. You just cannot afford to be asleep.